Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. We are deconstructing a systemic corporate illness, the bloated, backward-looking monthly business review. We'll look at exactly how high-growth leadership teams use the MBR as a rigorous operational deep dive and a true course correction cadence. To fix this complex organizational problem, we'll be moving through a tight 5-act playbook: the monthly review paradox, designing the agenda, variance commentary, integrating OKRs, and finally, governance and execution loops. Let's get right into it. Section 1. The monthly review paradox. Catching strategic drift. This brings us right to the VC paradox of 2026. We continually see these fragile, unstructured monthly meetings where executive teams just rehash stale metrics and furiously defend their past performance. It's a massive failure in governance. Look, a weekly meeting catches tactical blockers, but a monthly cadence? It's structurally designed to catch slow compounding variance and strategic drift. You absolutely must decouple your monthly financial variance reviews from your weekly tactical fires. Otherwise, you're going to lose strategic focus in the day-to-day noise. That decoupling is how you verify talent and uncover asymmetric information before the broader market does. The institutional stakes here are staggering. McKinsey research shows that roughly 70% of large-scale strategic initiatives completely fail. Why? Because executive leadership lacks a rigorous monthly mechanism to verify if an initiative's underlying assumptions still hold true. They simply don't have a cadence for root cause analysis and operational intervention. Moving to Section 2, designing the MBR agenda, focus and architecture.
An MBR that tries to cover everything covers absolutely nothing well. Let's look at the structural anatomy of an effective MBR agenda. We call this the climate tech supply chain edge, because our top-performing cross-border portfolios live by this structure. It's a ruthless 90-minute block. You've got strict time allocations for financial reconciliation, departmental bottleneck audits, cross-functional risk deep dives, and most importantly, resource reallocation gates.
To pull that off, you must kill the PowerPoint parade. High-performance teams rely heavily on pre-meeting asynchronous data distribution. We're talking about standardizing MBR inputs into a strict 2-page written narrative circulated 48 hours in advance. This totally shifts the room's energy away from first-read reactions and focuses everyone entirely on actual outcome movement. Inside that room, the rules have to be clinical and unyielding. Cap attendees strictly to true decision-makers who can execute resource reallocations. Absolutely no slides. And do not accept any updates without a clear, actionable recommendation. This is how you force real strategic alignment. Section 3, Mastering Variance Analysis Commentary Beyond the Numbers. This is a systemic issue across traditional funds right now. As Carl Seidman highlights, lazy commentary just restates what the numbers in the table already show. When financial controllers spend 80% of their time just gathering data, they rush this highly strategic commentary. And guess what? Board directors treat it as noise and just tune it out. True variance reconciliation isn't just historical accounting. It is the primary financial discipline your monthly cadence exists to enforce. It's the absolute bedrock of root cause analysis. It's the exact mechanism that prevents your executive team from losing their strategic focus to whatever operational fires happened earlier that week. To permanently stop lazy commentary, controllers have to adopt this repeatable flywheel framework. First, state the variance. Second, drill into the root cause. Third, quantify the forward impact. And fourth, recommend an action. This 4-part narrative transforms standard data into the most critical investment-grade page in your board pack. Setting a blended materiality threshold is also non-negotiable. Flag variances that exceed, say, $25,000 and 10% of the budget. Setting these strict thresholds cuts commentary volume by up to 60%. It creates the operational space to analyze the metrics that actually drive portfolio discipline. Moving to Section 4, Integrating Strategy and OKRs, Outcome versus Activity. If your OKRs live in one system and your MBR in another, you are just performing corporate theater. Conflating KPIs with OKRs is a massive operational trap. A highly functional MBR uses KPIs to spot the bleeding and OKRs to force a strategic decision to stop it. An objective like maintain churn below 4% is just a dashboard metric. It's not a deliberate operational intervention. When OKRs properly anchor your review, it enforces a repeatable, strategic conversation sequence. Outcome first, evidence next, decision last. This framework strips away the excuses, stops teams from hiding behind mere activity, and forces hard, data-driven decisions on actual outcome movement. Which brings us to Section 5, Governance and Execution Loops. What happens after the room? An MBR is completely worthless if the interventions don't survive contact with the next 4 weeks of reality. This is the ultimate test. What happens after the room? Without explicit execution loops, your team will suffer from corporate amnesia, and you'll open next month's meeting discussing the exact same departmental bottlenecks. By adopting strict red, yellow, and green decision rules, you are actively managing by exception. This enforces serious portfolio discipline. A red key result can never end with a passive, let's watch it for another month. It must trigger immediate executive intervention and a cross-functional risk audit. This framework beautifully ties back to a causal relationship map. It proves that if a team successfully executes the performance drivers, like launching a product, but completely fails to hit the outcome, then the fundamental theory underlying your strategy might be flawed. That's the asymmetric information you need to uncover. To completely close accountability loops, every single action item leaving that room must have 4 strict traits. 1 owner, 1 real due date, 1 explicit success condition, and 1 check-in point tracked in your weekly execution cadence. This is how you guarantee relentless forward momentum. You also have to reinforce organizational alignment post-meeting. Send a short note to the wider company containing only the executive conclusions and resource reallocation gates. Strip out all the departmental noise so the strategic narrative remains crystal clear. Rebuilding your MBR is not about creating a calmer, more polite meeting. It is purely about forcing better decisions, accelerating your execution cadence, and driving massive operating leverage by catching variance before it systematically compounds. Let's leave you with this final thought to evaluate your own execution loops. If your leadership team walked out of your last monthly business review today, could they name the top 3 strategic pivots or just the top 3 excuses? Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.